All right. Welcome, everyone. Thanks for joining on our midday lunchtime, depending on where you are. How I Raised session. I'm Charlie O'Donnell. And first of all, I want to thank Capita with a Q for sponsoring us. They are a cap table management platform, and we are talking about here trying to get people on your cap table, right? So a lot of people in the audience, their cap tables might be quite simple at the moment, but hopefully by the end of the session, we learn enough to make sure that they're a lot more complex soon, and you might need help managing that. One of our guests is making their way in. Vita is here, and I'm going to let you share a little bit about your background and what your company does before we do the deep dive.
Yeah, absolutely. And thank you for having me, Charlie.
No
So
problem.
I'm Vita. I'm the co-founder and CEO of Flock.ai. And basically think of us as the AI native visual commerce platform. We enable fashion and retail brands to create all the content that they need to sell a piece of product and do it from a simple iPhone photo. So think, from the factory or from the design team to everything they need for every channel on model images, videos, ghost only shots, like the full gambit. And then with that comes, how do you make sure you're showing the right content to the right user if you could suddenly make unlimited variations of content for every single SKU? How are you personalizing experiences? And how are you actually tracking what works? And so that's what Flock does from end to end around the creation, personalization, and the tracking. The reason that Flock exists is I did this before and I did it manually. So I used to handle photo shoot ops and merchandising at companies like Bloomingdale's, Jet.com, and Walmart. So that's really driven from the ground up how we've built out Flock to solve the problems of the people whose seat I used to sit in before.
Cool. And welcome. Glad you made it. I'm sorry that link didn't work out.
I'm so sorry, Charlie and Vita. So sorry for being late. I think one slightly with the link, and then unfortunately, I was tied with another call with a customer who really wanted to speak. But glad to be here.
You want to know something? That is a far more important conversation than what we have here. That's really incredibly important. And actually, your timing is perfect. And we'd love to know a little bit more about your background and then what the company does.
Awesome. Great. So very glad to be here. My name is Yuvraj. I'm the co-founder and CEO of Arusto. I was 17 when I founded my first company, which was a college counseling services firm, scaled it to around $1 million, then founded another D2C tech platform to help retail brands, scaled it to around another $1 million, and then unfortunately spent nearly a decade building learning academies for corporates, governments, working with consulting firms like McKinsey and working with governments in Middle East, Eastern Europe, US, and India. And it was during that time that I realized that adult learning content creation is not as easy as it seems from the outside. It actually is a really problematic area, very challenging, very expensive, and organizations are sticklers for that. So my co-founder and my undergrad friend, who's a machine learning engineer for the last decade, decided that we're going to take it upon ourselves to make the adult learning experience extremely easy for these organizations and allow anyone and everyone to create video-centric learning content, especially that is relevant in today's day and age because nobody likes to read. Everybody wants to watch a video to learn a new tool, to learn a new skill. So that's how Arusto came into existence. So about a year ago, we created Arusto, and the way we like to describe it is that it's essentially lovable to create video-centric instructional content for enterprises.
So actually, the fact that you bootstrapped a couple of businesses and drove revenue leads perfectly into my first question, because a lot of folks are sitting here trying to think like, fundraising is going to be really hard. Do I really even need the money? And I'm curious about your thinking, the decision, because we're going to go in chronological order here, the decision to even raise at all, especially in today's environment where, you can build a lot of things with less people. Tell me the reason why and what you think your criteria for deciding like, I'm going to need to go out and raise money for this.
Yeah. I think it's a very fair question. And I think it's probably like given less importance to because typically fundraise is associated so much with one's ego and like an external validation. I do feel that one needs to understand that what is it about my business which will benefit significantly from a fundraise. The previous two businesses that I did were not necessarily like relevant for a venture capital investment, right? They were either service-based businesses or they were targeting like very specific small set of customers, right? What we are doing today, one is targeting large enterprises who are already spending over $1 million annually on the value that we are adding to, right? Which means that they're going to have complicated processes to procure software, which means that they are going to go through proper detailed enterprise sales cycles, right? They are more mature with regards to like choosing their products. So you can't build like a patchy product and go and serve an enterprise, right? So for that, you need maybe a few more engineers than just your co-founder and yourself, right? You would also need a lot of compliance requirements in place. You will probably need to like slowly scale up a proper GTM stack. And all those things do require some sort of initial capital injection to give you the right to win, right? Secondly, I think that in some domains, there is also an opportunity of literally doing a land grab. And if you think that that opportunity exists, and it's very easy to convince yourself even when it doesn't, but if you fundamentally think that that opportunity exists, I think in that case, it is probably better to fundraise and then really go after covering as much domain and as much ground as you can so that you have a very dominant position in the market before somebody else can try and replicate and do something similar.
Gotcha. Vita, you building a fairly technical product. Engineers are not inexpensive. Was there a point at which you considered maybe pushing off raising? At what point, when you had this idea, did you decide to go out and raise? And also, did you feel like there was something you needed to prove before the raise? How much did you have when you first went out for your first round?
Yeah. So, no, like you mentioned, what we're building does require a lot of compute and, a lot of like verticalized kind of AI algos that need to be built. But before we went out and actually raised, the first thing we did is get investors comfortable around validating the market. So we actually went in with signed LOIs there were and design partners. So it was held together in the back end by duct tape and Figma screens, right? But helping them visualize what this could look like and what the impact could be like with a couple design partners and what they were looking for. Was really, really helpful for us. So at least we had some data points around, okay, brands, AI is scary, but brands need a verticalized solution. This is why they need it. Look at the type of brands that are already interested in giving us, data that they're willing for us to train on and look at the results that they're seeing with just something simple like this. Now, here's what the big vision could look like if we're able to do this at scale with the right compute and engineering. And we work with a lot of enterprise customers too. So, like, a big thing for them is this startup going to be around in 2 years, or am I going to be back in that like procurement process again? So those were a couple kind of key data points and reasons for us going out and fundraising, but it was not as easy for us to just be like, hey, we have this idea. There was as much as we could, right? Validation and kind of
So everyone has to go through this same exercise of like building the Google sheet. And I feel like most people just use Google Sheets for that. And what the list of investors and who knows what, and can make warm intros. I'm curious about the sourcing of the top of the funnel, the finding investors. And Vita, will dovetail off of you for a
yeah.
moment. When you decided to make that list of who to reach out to, what were the best sources and recommendations for building that up?
Yeah, I mean, this was where we spent a lot of our time before we even went out and started fundraising because it's all about having the investors on the same cycle and being able to, get everyone into the same process. So, some big areas that we looked at, PitchBook, if you can have access to it. I was in grad school when we started fundraising, and that was amazing because it's really important for you to understand. Right now, you can do this with like AI and stuff too, but like, what stages do they invest in? Are there certain principals or GPs there that really care about what you're building and what is their thesis around? Are they even the right fit? You can categorize by what type of investors do they like to go over? Which stages do they want to come into? Like, you don't want to be having wasted time on their side and your side, right? If you don't understand that fit from the beginning. So PitchBook was huge. Crunchbase is another one. NFX Signal is another one. This was like all the work done up front, right? To understand who was my target, at least like 100 investors is what I recommend, right? Who are like a target list of at least 100 investors that we can go after. Then back then, right, it was a lot of manual work of like, who do I know that is connected to someone at this firm that can do this for me? So an entire, again, live off of Google Sheets. So like Google Sheet filled out with the target investor list, what stage, what's their thesis, who at the firm do I want to connect with, who in my network is connected or tangentially like, related in some way that I can get that intro from and have all of that lined up before you tell everyone go. So then you can have all those conversations over the span of like 2 to 3 weeks. Because what's really rough is if you're having someone in the data room and then a new investor comes in a chat that you have and you're like, oh, we're really close. And they're like, we need more time to get to conviction. So happy to dig deeper into that. But those were some of the key points that we really focused on before we even took a single call.
So you lined up everybody perfectly, right? The 102-week, sprint. Was your effort as crisp and clean in that scenario?
I wish I was as organized as Vita. I was taking notes for the next race. uh, but yeah, I think unfortunately, like I wish though, I think that's the right way to do it. We did not plan it so well. We certainly did look up the right investors in our domain, in the right round, right check sizes, whether they are excited about it, whether they have anything to say about the thesis that we are working on. And I think we used like similar kind of tools, right? So in addition to what Vita mentioned, like, we certainly also used Apollo and Clay to get like a lot of that information. And then did a bunch of analysis to like figure out, okay, who are the really relevant set of investors. I think another thing we did after that was like a platform like Bridge, right? You can use that to really identify what are the warm intros that you can get to specific investors. And I think that goes a long way because in my opinion, cold emails like work maybe like, less than 5% of the time, or like probably even less than like 1% of the time, right? If you have a warm introduction, and that can come from like a founder friend, that can come from like one of your angel investors or one of your former colleagues, etc., that goes a long way. So our first approach was, out of all of the investors that we targeted, let us try to get warm introductions. Now, the nature of the warm introductions is that they might take a little bit longer to materialize. It also depends as to which time frame are you reaching out to the investors in, right? So we made a mistake of like reaching out around the holidays, which was not super productive. So you'll have an initial conversation and then everybody goes into the holidays mode, and then they'll come back and it almost re-triggers the entire cycle. So I think it was a bit more extended for us, but the general principle kind of stays the same. Another thing I would, though, say, which might be contrarian, is I think sometimes we should not restrict ourselves to just going after investors in your domain. Interestingly for us, a lot of investors outside of our domain showed a lot more interest than investors who would traditionally fall into the domain, which was a bit of a surprise for us. But yeah, I think as long as people fit into your stage and broadly kind of touch along the thesis, that certainly should be the right initial filter to go after, and then warm introductions for sure.
So, you make an interesting point about the domain. And actually, the last time we did this panel, all three founders that we had raised from generalist investors as opposed to people who focused either, on their domain or, based on their community or anything else along those lines. I think what happens actually is they're seeing a lot more. So in their funnel, you might be facing more competition, right? If you're in the ed tech space, they've seen every attempt at this. And I think sometimes they're a little more jaded, right? They've seen the time that somebody had tried this 3 years ago with slightly different technology, and you may believe that like now is the right time, but they've heard that for the last 15 years or so, right? Whereas a generalist, they may be coming to this problem for the first time. I do feel the slight need to defend VCs a little bit on the cold email thing, because I will 100% agree with you when the cold email is generic. And if it's very clear that I'm getting the same email as everybody else. But when I get an email that's like, I heard you on this specific podcast, and you made this point about looking for deals in this space, and therefore that's why we want to talk to you specifically. Now, that's hard and very time consuming to come up with a personalized email for all of those. At that point, you might as well get a warm intro sometimes. But I do feel like the quality and personalization around the email has a lot to do with the cold email percentages. And sometimes you just can't find a good reason. It's like, oh, you're an enterprise and we're an enterprise deal, and you don't have a Substack, so I don't really know anything about you, but we'll see, and that's just the way it is. Vita, I want to ask about the percentages, right? So you said, 100 investors. Let's talk about the reality of those funnels. So you reached out to 100. How many, and maybe it's worth distinguishing because you raised before this latest round.
Mhm.
So tell me just about the timing and the size. You raised a pre-seed and a seed. When
Yes.
for each?
Yeah, we raised a pre-seed of 1.5 April of 2024, and then we just closed our 6 million seed round like November of last year, so 2025.
Gotcha. So what was the meeting conversion rate? And did you do 100 each time?
The first one was definitely harder because there was nothing, right? We were truly selling the founding team and the vision and a couple design partners. This and a lot of the learnings from there is what we implemented in this round. So, how organized we were, the number of people we knew that we needed to have on the list. Were there some people that we kept kind of warm from last time that we were a little too early for, but they were interested in the thesis, right? And what we were building. Like all of that came together into building our target list for this time. In terms of the convos, well, one thing I didn't mention is prioritize finding the lead investor first before you go after the rest. So that was another really big thing where fine, it was like 100 people, but maybe not all 100 were lead investors, right? We tried to get those intros in first, people that could put in the terms, like, lay out what this should look like. After that, it is much, much easier, right, to have the final combos and get the rest of the round filled out. So we were probably like 40, 50 kind of chats in before we got in the lead investor. And the big thing there is like you can tell when they're interested or not, right? So like don't like that's why I'm like take all the intros, line them up, have them in like 2, 3 weeks because you can tell who's gonna move and who's kind of gonna drag their feet. And there's not much that you can do to convince them in the other way. So that was a really important thing. But once we had the initial chats, lead investor came in, then of course legal and diligence and all of that. But everyone else came into the round very quickly after we had that first like term sheet in hand and signed and ready to go.
And you said you had 40 or 50 chats before you got that. If you were to sort of guess, because I'm sure some of those people suddenly became more active after you had the term sheet, which is what
Yeah.
everybody says. How many of those 40, 50 did you feel like there's real movement here where they got
Yeah.
it?
It's not that high always, right? Because like you said, we did raise from a generalist firm in the end, but the thesis that they have is around enterprise and GTM motions and founders that have a unique insight into what they're building. So a lot still lined up to Flock in what we did. So in terms of like initial customers, or I say customers, so used to that mindset now, but like initial VC chats to like people that had movement, right? It's not as high as you'd expect, which is why I said that number before, right? You have a lot of conversations and it's not just about your product. It's about, do you have a connection to this VC that you're pretty much going to be like married to over the next like 10 years, right? Like, do they believe in you as founders and your vision and how there's so much that needs to line up? So it could even be like 10, 15% of people even want to take the next step. Then like, how many people actually get to the data room? Then of the data room, like how many people can you convert into a term sheet? So that's why I think it's really important to have that top of funnel that's, researched, well thought out, and try to make it all happen at once. Cause like you said, if you're like, hey, we're chatting now, but I have 3 people that are in the data room, like what does next steps look for you to get to that conviction of like wanting to go there and spend time? That's the easiest way to get people and investors to move along.
So, and we'll go back to the ed tech space. I'm curious and also I'd love to hear your numbers, right? Like how many folks reached out, how many folks did you reach out to, and how long before you got some traction?
Yeah. So I think we actually we had raised a little bit of money from angels, and I think that kind of became the trigger point for us. So this was anyhow like our first round, right? So that was the trigger point where people started making like organic introductions for us, and wherever we could start getting funds from initially when it came to like smaller funds or when it came to like angel investors, we just wanted to build that momentum, right? So we did not take an approach of like, let's first only find a lead investor, because I think One, if you are creating something which is even remotely connected to edtech, it is difficult to excite people. And I think secondly, like when you're first time kind of raising and you are getting to know the motions around the entire venture capital space, it also is great to show momentum, not just from a customer perspective, but also from an investor interest perspective, right? So the first thing that we did was, okay, great, we've hit a certain milestone. There is X more in commitment. Now let's try to like start speaking with like larger funds. All in all, I would say that we probably around I would say around 50 odd funds as well. In our case, because we were stitching the round, we got like different funds participating at different intervals of time, right? Then there were larger funds once we reached a certain level that wanted to then participate, right? Now, the challenge in that is that if you've already received amount of funding or if you've already received the commitment, you either have to expand the round or you have to say that, okay, let's stay in touch. And then maybe the next time around when we are raising, that's when some of those conversations can happen. And we did a little bit of both, right? So with funds where we could see that this is the right time and we can expand the round, let's have that conversation. But when it came to other funds where the ticket size was significantly larger and we could not rightfully justify that valuation or like even the use of funds at our current stage, we thought that it might be better for us to really keep that connection warm and probably reach that stage like 6 months down the line and then try to like, initiate that fundraise through those guys. And by that time, our process for getting a lead investor would probably become shorter.
Yeah, I think they are two different approaches, and this doesn't get talked about enough. There are some rounds where there's maybe some flexibility in the raise size, right? Where you say, you know what, like I know I could do something with 1 million. It doesn't have to be 2. And, or I go out on 1 million and my valuation is such where, given what we have, I'd be okay taking 2 with this level of dilution, but I could take 1. And there are other ones where, hey, if we don't do 7, there's really nothing to be had here, right? And
Yeah.
it's very difficult to small fund your way to 7.
For sure.
That's a lot of conversations, right? You're very unlikely to get a $250,000 commitment towards a $7 million round, because that fund's just going to be like, well, this thing's never going to close, so I'm not going to spend my time on it, right? Here's one where I'll throw the VCs under the bus. We always ask, why hasn't somebody else backed this? And so if you come forward and you say, look at my background, I've had all this success, I think it's like natural for a VC to say, all of the people that you worked with before, if you've been in circles of success, why aren't they backing you? Right. And even if it's your former boss with a 10K check or whatever, just to see that some momentum, I think is something that VCs are going to look for, even if it's not large checks.
Yeah, I think, sorry, to quick reflection on that, right? Like, I think we went with the same philosophy that if we can really mobilize our initial network and use that as a momentum, that could go a long way. And I think the other thing is, as you said, like with some organizations, it can matter a lot that I need to raise a specific amount of funding. If you are default alive, which means that you know that you can survive for the next 6 to 12 months quite easily and you can continue to grow, I think that's such a great position to be in your fundraise, right? And that can help you in both the strategies depending upon your stage.
For sure. So I want to also ask, because in the talking to 50 people and then getting a term sheet, a lot of times people feel like, well, it just takes that many, but what's not accounted for is your pitch may have changed or you're getting feedback on this. So Vita, I'm curious, do you have a sense that how you were pitching changed from meeting 1 to meeting 50? And do you think that helped at all?
Oh, yes. Yes. That's such a good call out, Charlie. I would say like tier your VCs too, right? When you're doing the initial outreach. So I said yes to everyone at once, but honestly, before you do that, like try to have friendlies, existing investors, angels, maybe people that aren't like a perfect fit for you and you just want to like test the pitch, see how it lands and have those chats first. Because we evolved so much from the first pitch to the last one. We managed to, pick up on so many things that especially generalists maybe don't get about the retail space and the fashion space and what's so unique to the type of buyer that we sell into that's not technical at all. So you're absolutely right. Like I would say make sure you have a lot of those. And that's part of like the prep before you even like go out and like fully say this is my 3 weeks of calls and nothing else, right? That you should definitely do. I don't even know which version of the pitch deck we were at when we finally spoke to our current lead investor. So yes, agreed with you there.
And do you think that could also go the other way, where you're sort of constantly hopping back and forth? You walk out of a meeting and they feel like, um, you're not focused on, I don't know, not in your case, but like you're not focused on consumer enough, or you should be more enterprisey, and you feel like you have to be reactive to whatever the last VC said.
But no, such a good layer to add on. What we did is like after we had all those calls, right, would really track the type of questions that came through. And we made sure that we weren't changing things fundamentally about what we believe in and what we know is true. So, hey, you use a human in the loop process. I don't want that. It's like, okay, we are not the right fit for you because we know why we need to do that and what that is getting for us. But what it really helps with is for people that don't come from the space, they don't understand that brands are spending like 1% to 2% of their revenue on content creation and they're getting one model shot in one way. It was things like that. Like, what are the most common questions that I'm getting, right, to help them understand how big of a problem, how big of an opportunity, how we're building uniquely. Like those were the kind of things that really helped us in our pitch and our, the way that we explained it. So the basis gets laid there because that's the biggest thing, especially early stage, right? Like how big of a problem is this and how are you uniquely positioned to solve it? So that's what we really focused on, being really reactive and like changing everything about how you're going to approach the market and this and that is really, it's like not good for you. You're going to go through way too many variations. And at the point that we did our seed, we had so much good data behind us and enterprise customers that we had signed. So we could have conviction and be like, look, this is what's worked. This is why we're going to keep doing it. But to help them understand like the frame of why we're approaching it like that and why we're the right team and why it has to be built like this, those were really iterative because we're not always talking to people that come from the retail space and know how big of a problem it is.
So I want to ask you both, because you mentioned the bigness of a problem and the sort of, I want to ask about the aggressiveness of a pitch. I think any honest entrepreneur has at some level, this is what I'm quite sure I can do. And then there's, if everything goes right, this is the largest possibility of this outcome. And I'm curious where you tuned your own internal compass on projections, size of the problem, because I feel like there's pressure to present a really big number, but you run up against this sense that you're blowing smoke, right? And so how would you guide a founder who says, I'm just a little uncomfortable saying this is going to be the biggest outcome you've ever had or whatever, when you're sitting here, you have like no customers yet, or maybe you've only got like one or two and everything's ahead of you. Did that come up for you at all? And how did you position that? Did you have the big hockey stick chart like everybody else? Vita, you want to jump in and then
Mean, the thing one, like they need certain outcomes, right? Like that's the thing that you want to make sure you hedge for to be VC backable. Like they need to see certain returns. So if you are in a certain space or like, the opportunity is just not big enough for them and them to exist as a fund, like it won't make sense. So that's like one caveat to, do I have to always make it seem big? Like if you want to go after venture funding, like, there needs to be some returns that they see. The other side of things is, what I've found is mostly when they ask me about this, they want to see my thought process and like what it could look like. Look, here we're starting with this. This is how big of a problem it is, but here's where I see the vision and why I think it's reasonable that we could be, going into these markets or expanding into this. And that's what makes it this really, really big opportunity. Oftentimes when they ask me about like the TAM and how big they think it could be, it feels like they're just trying to understand my reasoning, right? And like evaluating you a little bit about the founder because you're the visionary for this company. Ultimately, early stage, they're backing you and how you think about the world. So that's what I found it to be. And what I try to do, right, is still back it up with numbers. Like go back to the research and be like, here's XYZ interview where they literally said they spent $11 million every single year on photo shoots. Now look at all this research, and here's the steps that I've taken to back into why I think the market could be this big and why these signals are showing me that we should eventually expand into this. So honestly, it's not like, there's no right or wrong answer. It's really like a thought process thing about you that they're trying to understand. And if you want to go down the VC route, right, you have to be comfortable with finger in the air kind of assumptions because they know things are going to change for you, but they're just trying to understand you and how you think at that moment too.
So, Yuvraj, how did you get comfortable with your level of assumptions in that?
I think it's a very, very interesting question. So we thought that we had a huge TAM when we started presenting. And a lot of feedback that we got was that this is not big enough. And I was surprised with the expectations and the numbers which were floating around and the feedback that we were getting that we need at least $400-500 million of ARR being very easily achieved because now we're looking at like 50 billion, $100 billion markets. To be very honest, I felt that at a pre-seed stage, saying that something will certainly be $100 billion. And even if, we can all do really good math and we can back it up very well as well, that probably is not going to make sense, right? So I don't think that, in my opinion, that's the right match anyhow. Right. I do think that your market needs to be large enough because at the end of the day, a venture firm would have to really expect that every single investment nearly returns the fund back for them. Right. So is it large enough or is there a path, as Vita said, that for you to at least get to those level of outcomes, right? Every company is not going to be $100 billion market opportunity, but a lot of companies, especially being built today, can certainly be between 10 to 50, $60 billion market opportunities, right? Even if that is explained thoroughly well, and you have a mechanism of saying that, okay, I'm going to probably start with a smaller, more concentrated market, dominate that, and then show your path towards capturing adjacent markets with the same workflow or the same product. I think that can resonate well with certain type of investors. And if it still does not resonate with the type of investor that you're really trying to get on your cap table, I just don't think that that's going to work out well for you or for them in the long run. And that's just going to be a very stressful relationship for the next 10 years, right? So I would rather maybe figure out which investor is comfortable with the reasonably large TAM that you have, right? So we did not say that we have $100 billion TAM. We said yes, this is a good $40-50 billion opportunity. Today, we're focusing on something which is a $7 to $10 billion opportunity. And this is how we think that this is going to scale very well, right? So yeah, I think in my opinion, you need to also find where you are comfortable because you would know probably a lot more closely about how you think your product can actually fit into that market. Even if that market is large enough, can you honestly get to that scale? And how quickly can you get to that scale?
So let's talk terms and pricing and dilution and all of that sort of stuff. Everyone has that one set of YC friends that are telling you that everybody's raising it, $200 million pre-monies for seeds these days and all of that and the right amount of dilution to take and being dilution sensitive. So one, I want to ask how did you set your expectations going into a round and did you share that? Did you say, this is what we're looking for. We have certain thresholds. Or was it, listen, we need this money. This is the amount of money we need. And whatever the market will bear, we'll eventually want to.
Sure. So I think a very easy mechanism is look at your industry and you have a very good chart laid out that where are the top 25 percentile companies of this stage in a specific industry, what valuations are they getting, right? And I think you can probably very reasonably figure out what is the right number for you. I think another thing is I don't think initially one should be really stringent and greedy around the valuation. Of course, you want to make sure that you can make this product or make this platform into a reality and it can actually be of value. You will have plenty of opportunities if you do that really well to command the valuation tomorrow as compared to today, right? So we took a very reasonable route. We said that, okay, we are going to value ourselves somewhere between the top 50 to top 75 percentile. We need a little bit of money to get ourselves into becoming a mature company. And let's try to reach that as quickly as possible. We did not receive any pushbacks from any of our initial investors because we weren't asking for something which is extremely unreasonable. We also saw that as an opportunity that we know our pipeline is great. And when 6 months down the line, we're going to like show a 4x, 5x, automatically we will be able to command much higher valuations, which right now might not have like, solid reasons for us to do so. I think when you start talking to more larger investors, you have to then understand that they sometimes have certain ownership requirements or certain minimum check sizes, which would make sense for them. So we eventually got into those conversations where people are like, okay, we at least need to have like double digit ownership in the company, right? So that's where I think it becomes relevant to say, okay, what does it make sense for me today and for the company and where we are, right? But I think prior to that, it really is a secondary thing. As long as somebody's not like extremely lowballing you, there are people who will try to like tell you that like, at an extremely, extremely low valuation, you should certainly take this because otherwise your company can't stand, right? But I think I would rather not take that money and build it completely in a bootstrap manner and then take it to a stage where I can at least get some sort of bare minimum valuation that I'm comfortable with.
Vita, did you have a sort of similar approach to valuation, or for you was just making sure you raised enough the most important?
No, I second a lot of what Yuvraj said. Honestly, like if you're going out there and being like, I want this valuation, that's not going to roll over well with VCs. It's really about letting the market set the terms right. And the best way to, of course, like raise that is competing term sheets. Or if you're in the middle of the fundraise process and something has significantly shifted in your business. And for most VCs, when they're looking at like, hey, I'm raising this and like they're a lead, right? They'll automatically just do that calculation of like 24% like dilution. Okay, then they're looking at like this kind of valuation range that they're going for. So sometimes, with the range that we wanted to go after, what you said exactly happened to us, Yuvraj. We just like priced some people out because they were like, hey, my check size is this, but I'm not going to get even close to the ownership that I want. Like it's just not a fit, which is why that first part that we spoke about, Charlie, like what check sizes, where do they like to come in? Anything that you can find about the firm and how they like to invest, right? Makes a really big difference just for them and for you to keep the process like clean and tight. But no, we did not go out saying this is the valuation we want. Really like, hey, if we get this, this is what we can achieve with that funding. And then letting the term sheets come in and really using that to like figure out. Cause honestly, it's not even like going with like the biggest, like the largest term sheet. It's also like, who's the investor behind it? What value do they add? Like, how do you want that relationship to look like? Cause they're going to be with you for the next like 10 plus years. So all of that kind of comes into play in the final decision too.
So, first of all, if anybody from the chat has any questions they want to get in, feel free to toss them up now. But before we wrap, I also want to ask like your criteria for accepting people. You just made the great point that like these folks are going to be on your cap table. They're going to be in your life for quite a long time. And, to the extent that you chose one investor over another, or if anybody was left out, or if you just had those thoughts of like, at minimum, this is the kind of criteria for accepting, what are some of the things that you would recommend? And did you do references on folks before you took them? Tell me about the letting people in once they made an offer and you agreed.
Yeah, I mean, there was like a couple things that were important for us, right? We were doing our first price round, so we knew that they'd be on our board. And that was what we over indexed more for anything else, the partnership. We had a certain idea, right, around how we wanted them to think about Flock in the future. Did the visions align? The way that they like to work with their founders? Like there's so much that can go into it. So a lot of it was, yes, you learn a lot when you're meeting them in person and you're taking all these conversations. How do they ask about the data room? Are there unreasonable requests that are coming in? Like you can see a lot that happens in the process. Like you're evaluating them as much as they're evaluating you, right? It is an opportunity that you're giving them to be a part of your company. So that's the best way to think about it in the end, right? As that like final partnership that you wanted. But a couple things, right? Like the big thing was, do they align with our vision and how big this can be and like the way that we're approaching it? That's a really big thing, because if you get in and then they're asking for certain like levels of growth or like strategies or push into this and that you just don't believe in as a founder, that's going to be rough from day one. A lot of it was reference checks. Yes, they'll introduce you to some people, but like back channel and find ways right through your own network that you can understand. Big things are when things get tough, how do they react? There's been companies that I'm sure that they invested in that shut down. How do they approach situations like that? How much do they like to be involved? What do board meetings look like? What do they expect you to have prepared for? Like, there's so much variations in how each VC firm likes to be involved and what they like to do. Like, sometimes the really big guys, right? You're one out of 1,000. So that's another really big thing for us. We wanted to index for somebody that would be a smaller portfolio, that would know us intimately and could understand and be a big part of our journey. So we tried to over index for those guys that make a couple select investments every single year over like these large funds. So a couple, I'll think about if there's anything else that came to mind, but really like the people, how big is the fund? How many investments do they make? How do they like to operate? And then back channel with other founders, especially founders that maybe shut down their company, to understand, how they react to negative situations too.
Any other criteria that we should be considering or that you did when you let people in?
I think apart from like what Vita said, the only other thing we thought about, like when we were particularly speaking to folks who were coming from our domain, was that what kind of value proposition can they add, right? With a generalist, like the value proposition is going to be limited and across the lines that Vita mentioned, but are there any channel partnerships that you can activate for us, right? Like I don't expect like any VC to like make a ton of customer introductions, but are there any insane channel partnerships that you can make or like help us maybe unlock some of the other portfolio companies or their networks? I think that was certainly like something that we explored. And a few of the investors actually helped us like get a couple of our customers, right? So I think that certainly, and this was like prior to like them making an offer, if they are making those introductions, that automatically speaks a lot about like their intent and desire to work. I think one additional factor that we kept in mind, and I don't know how often that happens, but I think an investor's excitement about your business is great, but you don't want to turn that relationship into like a consulting where every month you're preparing like, nice presentations to give them an update. Yes, you should share all the information. You should meet the requirements, but you want to make sure that their involvement is not keeping you away from building the business, right? So we felt with a few conversations that their expectations were that every like couple of weeks or 3 weeks we will meet and then we will discuss the whole strategy. We just did not feel that that would be like the right thing to do.
Gotcha. Cool. So I want to tackle some of the questions in here. One, I'll grab sort of a VC protocol one is how do you ask a VC to be your lead? And what I would actually suggest to founders is that you should ask as many questions about the VC's process. And you should make sure you understand, do you take a lead? Coming out of the meeting, is this something that you are considering a lead check for? Is this a fit? I think too often people think that there's like, if you ask the question the right way, you could convince them to be a lead. And the reality is like they either do it or they don't. They are either considering it for this company or they are. But in this case, the question is about a pre-seed safe. And I would actually argue that most pre-seed safes don't need leads as long as you are setting a valuation that is reasonable, right? To look at industry benchmarks and say, no, I might be on the higher end of this, but I'm not at a point where anybody's going to kind of argue. And I think it's for your first round of financing, be it angels or pre-seed or what have you, it's not necessary. Vita, a question about design partners. Were they early adopters or were they folks that you literally were like sitting side by side with the Figma and you didn't have anything yet and they shared with you what they would want?
Yeah, the second one, it was really like, hey, what does this need to look like? What do you need to see? We're thinking about it this way. What's your feedback? And then actually getting it live on site too. So either like very, very reduced or honestly the first customer at like no cost. Truly like we want the data back from the results of the content that we put live on site. We want you to have, couple check-ins with us. So no, they were very much so from the ground up building with us.
And how would you have rated your VC networks? Because this question comes up all the time of like, I don't feel like I have these folks in my network. Maybe I'm not sort of on the insider. And that intimidates a lot of people about the fundraising process. So I'm just curious from your perspective, were these relationships that you had to work to get as part of this process, or did your network sort of come through? Yuvraj, did you know how many, like of the 50 people that you reached out to, how many did you know beforehand?
I think I probably knew like 5 or 6 people who would like directly be working with a venture capital firm. But beyond that, I think it was primarily just asking friends, other angel investors, I would say alumni of your schools, colleagues. That's how we expanded the network. And if you don't have a network, I think the best mechanism is that think about your fundraise probably 6 months down the road and start to engage or develop and get warm intros to people, just to at least familiarize yourself and let the investor know that you exist, right? And then while you're providing them updates, you will over a period of time, get people to be in your network, right? So I also eventually started adding a lot of investors on LinkedIn. I won't message them, but I would post regular updates of who are the new clients that we are working with, what is amazing about the product, what are the improvements. And at least sometimes it shows up on their feed and they're aware of you, right? So the probability of then getting a warm intro through a bridge or even a cold email being reverted is slightly higher. But yeah, I think not more than 5 or 6 people that I would say were my first degree contacts.
Well, the other thing I'll say too, and I think this is an area where founders maybe need to be a little more honest with themselves, is that ideally, if you're going to have a shot at being successful with this company, you should be in a network of people who, have had some success in space, to literally completely be an outsider, not just to VC, but to this industry. It's actually really hard to build a successful company that way. And I think VCs are kind of evaluating your ability to build your network because you're going to have to do it for the next 10 years in this company, right? So if you do feel like you are an outsider today when you're raising, maybe it's better off that you spend the next 6 months, like you said, becoming more of an insider than spend 6 months trying to raise, actually.
For sure.
Vita, how was your network before you started? Did you know the 100?
No, but what I lucked out on is I was in grad school when we were doing our first raise, right? So it was that community.
Oh, you
and that
played
network
the
there.
student card.
Oh, yes. Yes. Student card. They're always willing to connect with you if you're like, "Oh, hey, I want to just learn more and kind of get it in." A lot of classmates, right, that came from the space and could make intros. So I myself came from a very operational background, right? I was in fashion, I was in retail, barely touched VC. It was like Yuvraj mentioned, a lot of building that during my time at grad school. And then once we did the pre-seed, right, naturally people will reach out, your current investors will make more. And then a lot of events, I'm based out of New York City, but honestly, so many of these cities now have these entrepreneurial events and hubs, right? Really integrate yourself in there and make sure you're growing that. Even us, Charlie, right? Somehow I got one of our investors sent me that check writers, kind of pitch competition. That's how we met. So I agree. Make it a big part of you putting yourself out there, building your network, and having that at least 6 months before you actually go out and raise.
Well, listen, I can't thank you both enough for your time. You have lots of tasks on your to-do list to accomplish with the money that you raised. So congrats both on getting to this point and successfully raising. And we wish you the best of luck, in particular with Flock, because I'm an angel investor in full disclosure in the company. I don't know how serious I am about that. So anybody who's worthwhile to pitch me, but seeing the in-person pitch made a big difference for me. But thank you both and enjoy the rest of your day.
Great. Thank you so much, Charlie.
Bye-bye.
See you guys.